All right, welcome back to the show. Today we have two-time guest Matt Bilger with Colliers International. He's an appraiser with Colliers and does self-storage, but also does multifamily. And kind of wanted to bring him on mid-year to kind of give us an update as we had him on basically beginning of 2024 and kind of gave us a market update and wanted to get an updated just what's going on in the market with obviously self-storage, but anything else that's going on. So Matt, welcome back. Appreciate you coming on.
Thanks for having me. Me.
So to, I guess, generalize it, what are you seeing?
Well, again, from an appraiser's perspective, it certainly feels like the last, until about three months ago, things had been slow. We had been going on somewhere between 18 and 24 months of a slowdown. It was all, like everything else, was all driven by the interest rate increase that had been seen. Like I said, probably about 3 months ago, we started getting pretty busy, both on multifamily and on the self-storage side. We were kind of hesitant at first, not sure if it was just one of those things where, is this just another fit and start that's going to just peter out after a month? But it really seems like things have been, we may have turned a corner. There's a couple reasons for that. One is the fact, again, from an appraiser's perspective, we did a lot of appraisals during the boom years when interest rates were really low. During the pandemic and just post-pandemic. And we were anticipating a lot of these, terms, 1 year, 2 years, 3 year terms. We were expecting a lot of those things to come back, but lenders are able to do something that we call extend and pretend, which basically means your loan term expired, but you're regularly paying your note and on time, and you're a good customer to the bank, and they have some latitude to push out, basically just extend the term of your loan and just say, you know what, we're going to give you another 6 months or another 12 months exactly at the same terms that we're at. And, hopefully the rate environment will be better when this extension expires. There's a limit on how long they can do that. So anybody that could did it. And now we're kind of at the point where it's time to pay the piper. The nice thing is that even without rate cuts, interest rates have fallen. I've been talking with other appraisers about this. Not exactly sure. It seems like, maybe people are pricing in, the Fed's latest comments where they seem to be more concerned about, they have two things that they have to look at. They have to look at, keeping inflation under control. That's the top end. And that's why they'll increase interest rates. But then they don't want to increase interest rates so much that it causes unemployment to increase. That's their other directive, is to keep unemployment low. So they adjust the interest rates to try to keep those two things in balance. And so at the last time the Fed commented about this, they said they were much more worried about unemployment than they were about interest rates. And this is a change, and one that bodes well for interest rate potential interest rate reduction. For those who like to tie everything to politics, some would believe that it's baked in to give a interest rate decrease prior to the election. I don't know. I can't really speculate on it, but the thought was there might be one interest rate cut this year. So that has emboldened some investors. So I think those are a couple of the things. I also think that there has been some acceptance. It's having those low interest rates. It was like a sugar rush. It was really good. It tasted good, but it probably wasn't that good for us. Mm-hmm. You come off that sugar hangover, and it seems really hard to do deals at higher interest rates. But it's like we were getting deals done prior to the low interest rates, so it's not like we are an environment where you can't do business. It just takes a shifting of expectations. And it seems like that's happening. And people have kind of accepted the new normal. And so, like I said, it's translated into newer business for us. So,
sure.
Yeah.
So what type of buyers are you seeing? Basically, you said it opened back up 3 months ago compared to how the buyers were 2 to 3 years ago. Are you still seeing mom and pops? Are you seeing more institutionalized buyers? What type of buyers are you seeing?
So during the lull from, like I said, prior to first quarter of this year and earlier, we'd been almost all my work had been through mom and pops. Almost everything that I was doing regarding sales were local buyers and sellers, Class B, Class C assets, oftentimes in secondary or even very tertiary markets. There's a couple national buyers that had picked up some portfolios. I know Mini Mall Storage has been on a tear, buying a lot of stuff, but we weren't seeing a whole lot of that. We're starting to. It seems like the big boys were kind of keeping their powder dry and waiting for a more favorable environment. And so we're starting to see. I think I'd done maybe one Class A project, one or two, over like a 6-month span, maybe 3 between fourth quarter 2023 and first quarter 2024. But I've done more Class A stuff in the last 2 months than I had in the previous probably 6 to 9 months. So
that's interesting.
So it seems like a little bit of everything's getting done these days.
Yeah. Where have you seen cap rates go? We'll just say from 6 months ago to a year ago. Have they changed at all?
They have. So I was looking at this, and I'd actually spoken to a couple brokers about this, and when we talked 6 months ago, it seemed like at the low end of cap rates for Class A stuff, that really hasn't changed very much. But the upper end of Class A has fallen a little bit. So like previously we had quoted maybe 6 to 6.5 on a Class A property. The most recent comments I've gotten back from the brokers who are really active and again, this is specific to my region, Ohio and kind of the surrounding states, Midwest. Like I said, 6 to 6.25. They're for especially the Class A buyers who are more institutional or the REITs, they are willing to pay below what we're generally seeing. Because they're in their mind it's a long-term hold, and through rent increases and growth over the next few years, they will eventually get to the return that they seek long-term. So I had specifically asked, what's the floor? And really I was told that if you're doing if you have a Class A property and you're in lease up, 6 is about as low as you can go. Now, if you have a Class A property and you want to sell and you're already stabilized, now you're getting into the 5s. So there is, as an appraiser, we don't necessarily like that answer, but that's just kind of the reality of what's happening. If you have a Class A that's stabilized, you can go lower, but generally 6 is kind of the floor. For Class B stuff, on average, they're down about 25 bips from 6 months ago. They're ranging from low 6s, like maybe let's say 6.25 to 6.75. Class C is going to be 6.75 to maybe 7.5. So that's also down about 25 bips. I think I was at 7 to 8.5 6 months ago. So So overall, things have trended down a little bit. There's a lot of money chasing very few deals. If you're if you're trying to get some, it's very competitive out there, and it's hard to come to terms with buyers, especially when it's still a buyer's market, it's still a seller's market. Again, just because there's so much money out there trying to get assets.
Yeah. So, and I don't know if you'd have an idea on this, but comparing inventory from now to 6 months to a year ago, any idea? Sounds like you're saying there's less now. As
far properties available for purchase?
Yeah. Yep.
I think, there's still, I don't know that I haven't really done the research to see if there's more or less. What I can say with certainty is that we still have more buyers than sellers. And so, the thing, like I said, that has changed is that I'm starting to see, more Class A stuff go on the market. That's something that I really hadn't seen. I don't know about volume, but there's still been Class B and Class C stuff available for purchase. But the Class A stuff you just weren't seeing. We started to see more Class A stuff come online or come on the market for sale.
And that's more really new development.
In pockets, development it slowed down because of the interest rate environment, but it's still happening. And everything about this industry is it's in the pocket that you're located. If you have if there's large demand and you don't have enough supply, self-storage is still a very attractive asset to a lot of lenders. If you're in an area, we're past the days of if you build it, they will come, where you just throw up a building wherever. The industry's grown beyond that, and you simply can't count. You got to do your due diligence. You can't simply just get a piece of land and throw stuff everywhere. If you're in the right place, you might get lucky and it might work. But generally speaking, owners and developers are more sophisticated. Lenders are more sophisticated because they're more comfortable with the asset class, and but that also means they're familiar with it, which means it may get a little more scrutiny in their process. So, there have been some areas where, especially in areas where there are failing commercial corridors, we've seen some that have thrown up moratoriums on self-storage, just because it seems like every big box that closes gets filled with the self-storage, and it's debatable on whether it's wise or not, but some municipal leaders would like to try to keep their commercial corridors reserved for retail properties or retail tenants. So, like I said, depending upon the specifics, that's either a good move or ill-advised, but it really is on a case-by-case basis. But there are still properties being built, permits being issued, zoning's changed. It's people are still plugging away, not at the same clip that it was, during the low interest rate years, but deals are still happening. Properties are still being built.
Yeah. Are you seeing the similar trends with multifamily too?
Yeah, I'm a little bit skewed living in the Columbus area. It's the fastest. I've seen several sources that said it's the fastest growing metro in the Midwest. I've read articles in the newspapers that say that we are in a severe shortage of housing. It's kind of funny. I was doing a property in downtown Columbus that was a parking lot, and it was being converted, and it was an appraisal for a proposed apartment complex. And for my purposes, I was just valuing the land. But when I called the city to to get an idea of, what the density might be allowed, that it was almost embarrassing how much they fell all over themselves, trying to like encourage us to put more density in, and like, oh, well, he wants to put up like 30 stories. Is that too much? Well, we could go 40, 50. I mean, it was, and there was like 6 people on the chain. And then another person came and said, oh yeah, we, this property's near a big parking lot, so we can definitely like do this and do this. And it's like, and each person just kept adding, like they were so eager to get more housing. That's true of both of affordable and market rate stuff. There are areas like Franklinton that is, in a, I know gentrification is not can sometimes bring out some strong feelings, but that's what's happening in that area. And I've appraised a lot of them, and they're really, really nice product. It's an area that I might not have been comfortable walking through, 15 years ago, but it's a really nice area now. Any place on the Northern Arc, which in Columbus is kind of, like Hilliard on the west side to Gahanna on the east side. There's a lot of product going up there. Anyone that's from around this area is familiar with the Intel plant that's going in between New Albany and Johnstown, Johnsonville, up there. It's a $20 billion investment, biggest private investment in state history. So there's a lot of things to like. So like I said, my opinions are a little bit skewed because I do so much multifamily work in Columbus, and with it growing so fast there, I've done more proposed assignments in the last probably year than I had in like the previous 5. It's pretty crazy. And for anyone that is listening that is interested in apartment cap rates, in the major metros, Class A, you're probably about 5.5 to 5 3/4. I know in the best submarket, short north of Columbus, you can get 5 1/4. Class B is going to be, if you're B plus and like really good in a great submarket, you might be able to get sub 6, but otherwise you're probably 6 to 6 1/4. Class C is probably going to be, 6 1/4 to 7. Cap rates those are all stabilized cap rates. Cap rates can go higher, but the thing is with all the Class C work I'm doing, nobody's buying a Class C or refinancing a Class C and asking me to provide an as-is value. They're always asking for, it's always an upside play, right? You buy one of those, you put in, depending upon how much work it needs, anywhere between $5,000 to maybe $30,000 a door. You jack up the rents, and you cut expenses where possible. And so, since I'm pretty much exclusively looking at Class C properties that have either just been renovated and now they're refined, or they're about to be renovated, and my cap rate is stabilized. So if you're not stabilized, you could be in, I'd probably say 7 to 8. If you're higher than that, it's either a really bad property or with some atypical situations going on, or maybe you've got an appraiser that doesn't quite know what they're doing.
No, that all makes sense. So last question I got is, get your crystal ball out. I think I read this morning there's 100% chance of a rate decrease in September, which to me is like I can't even, there's nothing's 100%. But everyone's calling for it. We'll see what they do. If they do at least lower rates one time this year, what do you think will happen?
I think I've heard some people say, oh, it's not going to make that much of a difference because people feel optimistic that a rate's coming. So they're already starting to price in like lower rates a little bit. So when it actually happens, it'll just validate it. And maybe we may not see that big of a change. Personally, I think it's going to be a big change because I think so many people are waiting. We've been waiting for this for a while. I think that it's going to cause a lot of people that were on the sidelines to finally make a move. And with all that excess capital entering the market, I think deals are going to get done. I think, we're not going to return to the low interest rates of the pre-pandemic or of the pandemic years, but I think it's likely that there will be a cut, and I think that it will mean I think it will continue the trend that we're already seeing of interest rates going down. I think there'll be there's always, whenever you got an election coming up, that I always hear people, well, if one party wins, we're thinking this. If another party wins, we're thinking this. And so, who knows in that sense? But I think that interest rate cuts are obviously a good thing for investors, and it will help get more deals done and make borrowing, of course, more affordable.
Yeah. So. Yeah. No, I agree. I think there's been a lot of people sitting on the sidelines, and I think even if they lower 0.25%, which I'd be shocked if they go 0.5%. I think either way, if they lower, I don't think it'll be good for long term. From everything I'm hearing, I'm not an expert, but just everything I'm hearing, it doesn't sound like it'd be good long term. But like you said, election year coming up, there's a lot of variables there. They'll probably lower it, so we'll see. But yeah, I think a lot of people are sitting. I think there'll be a lot of refinances done. I think there'll just be a lot of movement going on.
I had seen something recently where there was, I know, and again, this is more my business than what would it impact, general investors, but something like, I'd seen something that maybe 10% of commercial loans are in default or in technical default right now. So I know we're anticipating a busy fourth quarter because we expect those to flow through the system, and we're starting to see more work from special servicers that are, for those who don't know, special servicers are brought in when a property is in default, and they will manage and operate the property on behalf of a bank to either bring it back on track or to liquidate it. So it's
that's interesting.
Yeah. So maybe some deals to be had there.
Yeah, for sure. And actually, we talked about that on one episode where you can find deals that are in default that basically aren't making their loan payments. You can find records of that and the banks that have them, and you can reach out to those banks and try to purchase them. It's a lot of work to get there, but you can definitely do it.
Yeah.
So what we miss? What else do you have to add?
The thing that everybody's talking about, at least in my circles with self-storage, I don't remember if I mentioned this last time, but it's a ECRI. That's existing customer rent increases. It's we've been seeing, I'd say vacancy is up a little bit across the board on all asset classes for self-storage. Again, this is very, self-storage is very pocket driven. If your 3 to 5 mile radius is good, then who cares what's going on nationally or regionally? But in general, vacancy rates are up a little bit. Rent increases, again, some pockets we're seeing decreases in rent, and other pockets we're seeing rent increases on asking rents. In the previous years, it didn't really matter wherever you are, unless you were in Denver or some other markets that were, highly publicized as being way overbuilt. Pretty much everywhere was having strong rent increases. And now what's become very popular with this ECRI is that anyone who is, whether you are a REIT or a large operator, or if you're you've competed against one, you've seen the way that a lot of them tend to work, where they will offer really low asking rates, and then they will increase the rates, after 3 months, after 6 months, maybe monthly. I know that as an owner as well, I have a competitor that, I've had customers come to me and say, I'll pay you more if you just guarantee my rate for, 6 months, 12 months. Just let me know right now how much I'm going to pay every month. Knowing what you're going to pay, what it's going to cost you, being able to budget means a lot to a lot of tenants. And so I think that's a place where if you're a mom and pop operator, you can really differentiate yourself from the big boys. Just the peace of mind that they're not going, that they don't have to open up their bill every month and be surprised. But that's where the REITs and the big operators are continuing to see their growth, because their asking rates are down. They're just trying to get people in the door, and then with the ECRI just having increasing your existing customers' rents and just bumping them up. Statistics show that most people will just I kind of call it like the cable bill effect, where how many times did the cable company raise my bill? It was like 2 years before I finally cut it. And it's kind of the same thing with self-storage. Some people, they're going to complain anytime there's a rate increase, but it's a lot easier to just write the check than it is to move everything out of your unit and look for a better deal. So that's how you're able to increase your rents sometimes. And so that's where the big companies are really focusing on it. I know it makes my job harder, because oftentimes we would look at asking rents. We look at the in-place actuals. We would compare the actual averages and the asking rents to what your comps show. And if your asking rents are within that range and there's not that big of a spread between your asking and actuals, we'll give credit for your asking rates. But now, like I said, we struggle sometimes because the asking rates will actually be lower than the in-place averages. And so it's like, well, the old thought was, well, if you're asking for less than what you're getting, that suggests that your rents are above market, and that would negatively impact you. And we have to kind of change our thinking, because it's becoming more and more common because of this, where the asking rents are now lower just to entice people, and then they bring them up. So it's made my job harder, but it's we'll figure this one out too.
Yeah. Oh, it's made everyone's job harder. It's unless you're in the market, right? Unless you already have a facility in the market as owners, like it's the same thing. When you're trying to underwrite a new deal and they're they're $20 for 10 by 10 for the first month, and then they jack it up to $100 second month, we have no idea. So yeah, trying to find market comps is very hard on underwriting deals. So
yeah,
cool. Well, this has been awesome, man. Very helpful. A lot of great information. I know we've done this before, and we'll put this in the show notes, but where can people find you?
You can email me at matt.bilger@colliers.com. That's matt.billiers@COLLIERS.com. Also, feel free to reach out. We have a quarterly newsletter that we regularly write articles for, or that I regularly write articles for. Feel free to request that. If you have any questions or, about a particular property that you're looking at, or if you need some advice or an opinion or an appraisal, feel free to reach out. I'm happy to help.
Yep. And you're in Ohio, but you'll do multifamily self-storage in all the neighboring states of
Ohio.
Right?
I'm licensed in Ohio and all the surrounding states. That's generally my sandbox that I play in. For our self-storage team, to be on the self-storage team, you have to, go to the regional trade shows, occasionally go to the national trade shows, do events like, do things like this, promoting yourself and the team. I do lunch and learns, and I've spoken, both virtual and in person. You have to write articles for the newsletter. It really wasn't, to be on that team, you really have to know your stuff. And so if some of you may say, "Oh, thank God, Matt's not in my market. I don't have to deal with him." And I can assure you that everyone that's on the Call Your Self Storage team is an elite professional and really knows their stuff. So if I can't help you, I can definitely direct you to someone who can.
Awesome. Well, again, appreciate you coming on. This is awesome information, and we'll see you guys next time.
Thanks for following, subscribing, and listening to this episode of the Do More podcast hosted by John Farling. To learn more or ask questions, go to l4investing.com.